Welcome to the Investors Podcast. I'm your host, Stig Brodersen, and I am sort of here for the mastermind meeting, if I can call it like that. So Preston isn't here. We chose because Preston is doing all his thing with Bitcoin, so he hasn't been a part of the group here for the past, I think, 2 times now. Hari had a last-minute family emergency, and so, if you can call Toby and me the mastermind group. What do you think, Toby? Can we call the mastermind group meeting just you and I?
I think we should call it the mastermind group, but we should just point out it's just the two of us.
Right. I was thinking chat with Toby. I think that sounded a lot more sophisticated.
Chat with Stig.
Right. Let's see. So, but we're still doing the same format. Like we both had a pick prepared, something we want to talk about, and then perhaps we had something afterwards. We had a chance now have time to chat about. Now without Preston, Hari taking up all the talking. So Toby,
finally.
Why don't you? Right, finally, yes, we waited since 2015 to have this conversation, Toby. So perhaps I think you always been good starting out. The rest of us being too nervous to get started. So I know you want to talk about home builders. So I want to throw it over to you.
Most folks will know that in the States there was a home building boom through the first decade of the millennium, and that then resulted in a monster bust. And so there have been lots of movies made about that. Mike Burry being featured in The Big Short because he was trading the derivatives off those things. But basically, the bust was so devastating that the last decade, which is the second decade of the millennium, everybody has underinvested in home. The home starts have been well below average, and we're only now. So we've got home start data going all the way back to 1959 in the States, and you can look at that, and it's this pretty. It's easy to see what happens. There's this sawtooth pattern where the market gets too hot probably, and then it crashes, and it starts from a low base, and it runs back up again until it gets too hot, and then it crashes. And that pattern has occurred pretty consistently since 1959. What stands out about the most recent bust, which was the 2007-8-9 bust, was that the new starts fell to the lowest number that is in the data running back to 1959. And then the starts have run up at this much lower rate than they have in previous booms. So this boom has been going on for a little while, but it's still really only back to about the long run average. So it's the June data that we have is about 1,643. I think that's 1,000 starts. So I've been invested in the Acquirers Fund, which the ticker is ZIG. We've got exposure to a number of home builders, Pulte, DHI, which is DR Horton, and MTH, which is Meritage. I'm just going to talk today about Pulte for a variety of reasons. I think that it's the best of the three on some measures. The other two are very good opportunities as well. I sort of think this is an industry that's got a secular tailwind behind it for the foreseeable 5 or 10 years. And if you're in the better, safer names, I think you're going to do pretty well. So my pick is Pulte, and the ticker is PHM. Pulte is it's about a $14 billion market cap as of today. It's de minimis net debt. They've got some debt, but they've got some cash balancing that debt against that. The company itself has been around for about 70 years, and it's got this nice geographic diversification, and it's got a nice price point in the homes that it builds. So half of its homes it builds for less than $400,000, or half the homes that it builds sell for less than $400,000. 75% of the homes sell for less than $500,000, which is around the median, a little bit north of the median in the States. So they're selling to the very a very broad market of people. Last year, they did about $12 billion in revenues. And if you look back over the last sort of since the 2009 low, they've grown very consistently through that entire period. They've got a very solid balance sheet. And so the things that I really like about it, that very safe balance sheet, I think it's got one of the best balance sheets in the industry. And it's also got these great gross margins. They make a lot of money, and they keep a lot of money from each home that they build. So they've got the lowest debt to capital ratio in the industry. So just for those reasons, I think it's the safest. It's the safest bet. I think it's one of the better builders out there. They know what they're doing. They're making lots of money. They've got this great geographic diversification. And I think that the industry tailwinds mean that these, you can almost pick whichever one you want, but I just pick the better, safer ones. I think that it'll do pretty well. For all of that, it's trading on a P of 9 or below, depending on where you look. Acquirers multiple, which is my preferred measure, around 7. So I think it's a reasonable bet. It's got a little dividend yield of about 1%. They're reinvesting in land and so on. So it's a business that I think will continue to grow, particularly if they get these secular tailwinds. So we've underinvested in housing for a decade. It looks like now that's starting to kick off as millennials transition into wanting suburban houses and they start having kids. And so we're short quite a few homes, and we're going to have to build those over the next 5 or 10 years. So for me, I think the industry is likely to do well. I think this is one of the safer, better options in the industry, along with Meritage and D.R. Horton. So that's my pick. It's Pulte. What do you think, Stig?
Well, I'm thinking a lot of things. As always, I like something that looks cheap. I can't help but whenever I look at the numbers, I'm like, yeah, why is it that cheap? Just keep that in mind whenever I'm showing you my pick afterwards, Toby, where you're going to be like, yeah, there's a reason why people are not buying this. I look at here the consensus forward PE, which is it's always a tricky number to look at, but it's always fun to see how well. Which is 7, by the way. Aside from you can see from the market, like what are the analysts saying, and then you can go in and figure out why they're saying that. But if you look at that, why is it only 7? Like sounds almost too good to be true.
Yeah, I think a lot of it is the overhang from the great financial crisis, global financial crisis. What are we calling that these days? The GFC?
Yeah, I'm not sure. I heard you say GFC a few times on the show, and I was like, what does it mean about? Oh, the great financial crisis. So I actually started using it a few times as well.
The global financial crisis. So or the credit crisis. I think that people got burned really badly through that collapse, and you can see why. With the market ran up to, it was one of the hottest home start periods, and then it fell to the lowest ever on record, and all of these things got absolutely smashed to smithereens. And so I think that it suffered from that. So they have had this overhang. There's a record of people getting hurt in the equity, and so I think that's part of it. I think the other part of it is just the market has been a tech software as a service high growth market for the last decade, and so anything that is like this that's reasonably capital intensive has suffered as a result. And so for those two reasons, I think that it's been overlooked. But for some other reasons, I think it's sort of at this inflection point where it still looks reasonably valued, even though you can have a look at the last decade. It's done on a stock price basis. Like since 2011, I think it ran from $3 to about $53, $52 today. So it's done pretty well over that decade, even though that there hasn't been the sort of supply, there haven't been the sales of these houses that you might expect given the underlying demographics. So I think it's just one of those times where you can't necessarily see it in the historical data. You just have to understand the underlying demand growth and the supply picture, the current supply picture, and what that means for the next 5 or 10 years is that there's going to have to be a lot of supply. There are a number of companies that are going to be beneficiaries of this. Pulte, I think, is one of them. And I just my bias is always towards the safer, better companies. There are lots of different ways to play it. You could play the marginal, the more expensive ones that will probably whipsaw a little bit. Not whipsaw, but the tail. The end of the end of the whip will sort of crack a little bit harder, but I just think that this is the safer, surer option. Pulte, any of those sort of three, but Pulte being my preferred one.
So whenever I look at the numbers, I can't help but think whether or not this is at the top of the cycle. And in all fairness, this is your pick, and I'm sure hopefully you understand this pick a lot better than I am. But I look at that bottom line. I look at the top line and see how it's grown. Also keep in mind that we have this huge bust. I can see that the gross margins are slowly creeping up. It looks really, really nice. They're starting to pay out this dividend. It's a small dividend, call it 1% or so, but that's trending upwards too. Strong balance sheet, all the things you want to see. And then you're seeing at the TTM, or the trailing 12 month, you have $6.18. It might look like it might be slightly more here whenever you do the next financial year. And then you're like, I wonder what the stock is trading at. It should probably be trading at, I don't know, $100 or something like that. Probably north of $100. And today, here, 17th of August, it's trading at 54. The market just opened. And you're like, huh. And so sometimes whenever I've seen things like that, and I can tell that from bitter experience, sometimes I've seen numbers like this, and perfect as I am with timing, everyone else, it looks like, knows that this is a cyclical stock, and sometimes it look really cheap, like the airlines or whatnot, and then you see that bust, and then you sort of like see that turn around. So I'm trying here to show. So for those of you who are not following this on YouTube, it doesn't really make any sense whenever I'm like drawing things in the air. But I was trying to like draw the boom and bust here. So how does the cyclicality then play into your thesis here, Toby?
It's certainly a cyclical. There's no question about that. The driver of the cycle is home starts, and you can pull this. This data is from the Alfred website. If you just Google FRED, Fred, home starts or housing starts, it'll pull up this chart, and you can look at it, the data going back to 1959, and you can see this very distinct sawtooth pattern, as I was referring to earlier, that at the very peak. So in 2007, I think we were doing, just from memory, we were doing something like 2,700 or 2,800 starts. And now, as of June, we did 1,600. And it bottomed at 478 starts in April 2009, call it. So, and it's crept back up really, really slowly. If you look at the other boom periods, they ramp much more quickly, and they top out at a much, much higher number. And so to my eye, it looks like we're about mid-cycle. And so for those reasons that I identified before, I think that there's a little bit of an overhang because the GFC is still, global financial crisis is still very fresh in the minds of a lot of investors. And it's a capital intensive business. It's not software as a service. It's not as great a business as that. It's not a spectacular business like that, but it is entering into the second half of its cycle where it will become much more profitable, and it's going to look like a much better stock over the next few years. And I just think you're in this sort of little period now where you can get it at a reasonable valuation before it really does start to run. And then you've probably got 5 or 10 years to sort of enjoy that. I still think these are very good businesses. I don't think you necessarily need to buy and sell them. I'm just saying at this point, it's pretty good risk reward.
So one thing, and you know me, Toby, I always like to play devil's advocate, even whenever you bring these awesome picks to the group. You're like, why are you so negative? But we always wanted to like figure out the negative before we make that major investment. But how about inflation? Does that play into your thesis in any kind of way? I would imagine that it's a relatively capital intensive, being a home builder company, making having your profits, saved up in old dollars, having to pay for new in new dollars. Could you talk to me about like the cash flow, the inflation? Do you even see inflation being an issue?
The sensitivities for home builders are interest rates. And so as interest rates go up, home prices have to come down because people can't borrow as much to pay for the homes. But that's why it's important that this has two important qualities to it. One is that it's got the geographic diversification, so it's not concentrated in any particular market that might be hot or might miss out completely on what's happening. And the price points are material to it. Under $400,000 for half, a little bit over half of their homes, and under $500,000 for 75% of their homes. They're in that part of the market where there is a great deal of demand. And if you work out the interest rate impact on those homes, interest rates going up a few percent, maybe running back to like the long run average, it adds like $50 to $75 a month in terms of cost of owning the house. So I think that millennials, I've gone through this experience over the last 5 years where one kid you can live in an apartment, 2 kids you can't really live in an apartment, and 3 kids you have to have a house. I'm not saying nobody's rushing out there to have 3 kids. That's a lot of kids, but 2 kids is you probably need a house. And I think millennials are going through that process now where you discover that you can't stay in an apartment. You need to move out into the burbs. You need a backyard. And I think that demographic shift as they start buying houses, and that, by the way, that has an impact on a lot of other industries too. That will show up in furniture, and it will show up in places that supply stuff for the home, like Williams-Sonoma and those kind of businesses, which is another interesting one that I like too.
Yeah, that's interesting. Yeah. Well, Toby, I might as well jump in.
Let's do Bubba.
Before you start bashing me, I actually have one question. Actually, I had one question I wanted to ask you, because I remember, back in the good old day here 2 or 3 mastermind groups ago, and we were like 4 people, and like well, we were still recording, but we took that out afterwards. You and Preston were like going head to head in terms of inflation. And at the time, Preston was saying, he looks very much at the money supply, and you were like, yeah, I don't think inflation is that high. And I could see, like, in Preston's eyes, like he was good to go, like he was about to have the discussion. You were like, yeah, Preston, let's bring you on my podcast. Let's just do an hour on that conversation. So
I think it was on Bitcoin, wasn't it? It wasn't necessarily on inflation. I'm a believer that inflation is like chronically understated.
You believe it's okay? So actually, let's talk about that, because I think in relation to your pick, it's really important to understand, since it's so interest rate sensitive. And so we can probably just lead out by saying, if you have a high inflation, then generally you would like to increase rates if you're the Fed, because you want to put a damper on inflation. And so that would be that would have detrimental effect on a company like PSM. And so.
Well, let's talk a little bit about where we are in the market, just so folks know what's happening. So the 10-year at the moment is about 1.3%, which is a historically quite a low yield. Long run average is about 6%. Recently, though, that is a reasonably high yield. Over the last 12 months, it got down. I think it got under 60 bips, which is 0.6% through the middle of the 2020 drawdown. So it's run up quite a bit, and that has coincided with value stocks doing much better. So this is why I watch it so closely, because value will do better as inflation kicks up a little bit, because the underlying cash flows become much more valuable as inflation kicks up. Now you look at inflation estimates. So where the last print that I saw was 5.4%. You contrast that with 1.3%. On the 10-year, that means that the real yield is negative 4.1%. It's very hard for bondholders. Bondholders are losing 4.1%, a year. If nothing changes, they go on to lose 4.1% a year, which is chewing up a lot of capital year on year. You cannot sustain that for very long. So one of two things has to happen. Either that inflation print is completely wrong, and it's all transitory, and it's as a result of a low base in 2020, and it's going to look much different when everything calms down and the supply all goes back to normal, because we also had that quarantine, the shutdown, everything stopped and got rebooted, and it's had this crazy prices in lumber, which is an input into housing, has gone absolutely bananas. It ran up and then it's run back down again. A lot of commodities look the same. Or rates go up. It's very hard for rates to go up because the government, the federal government here is carrying a lot of debt. And so there's a point at which the interest rates start impacting the government's ability to make its payments. So I don't think the Fed's going to be like the Japanese central bank. They're not going to let the rates run up, but it may mean that we have this very high rate of inflation and interest rates pinned low. So I have no idea. That's a scary kind of thought. That's like a 70s stagflation style environment, which I think is that there's a reasonable chance that we are in that or going into that. Is that doomy enough? Would Preston approve of that?
I don't know. It's probably not fair since he's not there.
My argument on Bitcoin, just because I remember that discussion, that I just said that there's an enormous amount of speculation in Bitcoin. That's all I was saying. I just said you can't use so much the price as the price of Bitcoin as the indicator of pure money supply, because there's so much speculation. And I think if we can go back and get the timestamp on that, probably I've done pretty well with the Bitcoin price there. If I was nominally short and you guys were nominally long, I think I've probably got the better end of that deal.
Right. So whenever you say inflation is understated, we had this just recently. I had this interview with Colin Rhodes, our masterclass in inflation, and we talked a lot about like how he defined it, and like we had multiple really smart people, including Colin Rhodes, on the podcast to talk about how they look at inflation, how they define it, and it's very different. Most people agree that it's not CPI, it's not what comes out, but you would have people who are saying, M2, or like it will be all over the place. I'm curious to hear like what are your thoughts on that, Toby? How big is what is the inflation number? Not necessarily a specific number. If you can say 2.23, that's fine. But like, how do you look at that?
The CPI is the Consumer Price Index, is one measure of inflation, but it is not inflation itself. So that's the way I think about it. So the CPI is this chained basket of prices where they look at from period to period and compare to the last period and look at the change in the price of the goods in that basket to give you a sense of what inflation might be. And it's geographic. I think they drill down to the city level, or at least the state level. The problem that I have with it, and I think a lot of other people have with it, is these hedonic adjustments that they make. I think in some instances the hedonic adjustments are fair, and in other instances they are not. So the hedonic adjustment is if steak gets too expensive, well, there are substitutions as well. So if steak gets too expensive and you would substitute mince for steak, which might be cheaper, then that reduces the CPI doesn't reflect that increase in steak prices, which just seems insane to me that it does that. It also excludes energy and it excludes housing, which are two pretty big cost centers in most people's lives. And then they make these hedonic adjustments. So televisions have got better resolutions and bigger, and televisions that were extraordinarily were $20,000 televisions 20 years ago, you probably just about get them for like $100 now. And a really good big TV might be a few $1,000s. So that the CPI has to adjust for that somehow. Computers get more expensive, cars get better, TVs get better. And so they make these hedonic adjustments for those things. Whether all of that is warranted or not, I think it muddies the picture a little bit, makes it a little. I don't know why the Fed gets the benefit of the technological advances that folks make to pin down the CPI. So the CPI is an imperfect measure of it. And it seems to always sort of slightly understate the true rate of inflation. And the reason is that, it's that there are a lot of government prices that are chained to CPI. And so they want to reduce their payouts for various of these things. And so keeping a low CPI, understating CPI is to their advantage. And so that's why CPI tends to be understated. So I don't think CPI is a true reflection of inflation. There are other competing services out there like Shadow Stats, which uses the 1970s definition of inflation, and they've always got it running at 10% plus. There was this MIT billion price project, I think it was, and for a long time that showed it was running really, really hot. And so then they went in and they fixed it with air quotes so that it no longer runs really, really hot. And then there are some other woods, like, I'm going to slightly mangle this name, but there's the Cottonwood Index, Chatwood Index, excuse me. And the Chatwood Index, which is now gone from the internet and scrubbed from the internet, but the Chatwood Index tracked for each city the amount of money that a family actually spends on various things. And it was running very, very hot. It was sort of like 10 or 11% a year. So I don't, everybody, this is it's a very political argument. So basically your politics determine which index you prefer to believe. And if you say that you like Chatwood or Shadow Stats, you're making a declaration that you're sort of outside of the mainstream. And if you prefer the CPI, you're very inside the mainstream. I don't know which one's true. I think CPI is probably understated. The other ones, maybe they're slightly overstating it. I'm not sure. It's probably somewhere in the middle. It doesn't really change. The real measure of it is ultimately, it's probably going to be the 10-year or something like that, because just bond buyers won't sit in stuff that's constantly chewing up their capital. So I think that you probably see the 10-year has to run up a little bit through here. And I think fair value for it's probably 1.5% now, probably look more like 2% at the end of the year. And if it does that, that's going to be interesting to see the impact on some of the tech stocks.
Yeah. Do you think? And no, it's it's always a lost cause to talk about what the Fed's gonna do, and where do we see the interest rate going? Because there was so much at play here. We talked about entitlements, and why we always, or perhaps why the government wants to peg the inflation low. But like, do you see inflation or interest rate going up because of inflation going up here, as people have been talking about for a long time now, knowing obviously also that the inflation number you see now is because of the base effects to some extent from last year. Base effect meaning that you saw these deflationary pressures in 2020 because of COVID, and so do you see that? There've been a lot of talks on those two hikes in 2022 perhaps already instead of 2023. Like, how do you see that discussion whenever you look at your own portfolio, whenever you look at PSM? Is that something you pay attention to at all?
Not really, honestly, because I just think it's too hard to predict. It's sort of, there's that Peter Lynch line where he says that 15 minutes spent worrying about macro is 15 minutes too much, or something like that. Right. I like talking about it, and I like thinking about the impact that it could potentially have on the portfolio, but I don't make any investment decisions based on it, because I just know that I'll be wrong, and I don't want it to influence what I do in the portfolio. The portfolio is always going to be concentrated into the cheapest things in the market, because I think that that's an evergreen strategy. It just makes logical sense to me that if you can buy cheap cash flows, then you should do that. And over time, if they do other things like buy back stock over time, that will be reflected in the value of the share price. There will be better times for that strategy and worse times for that strategy. And it turns out that when the market is very bullish, when there's a lot of capital around, that strategy doesn't do very well, because the constraints that I impose on it, which is that they don't raise a lot of external money. They're sort of internally funded for the most part, buying back stock, and they tend to be more mature companies. They're not at that very fast rate of growth. They're still very good companies, I think, very good businesses, but they're at that slower rate of growth. And so they're less attractive to people who are actively searching for growth. And, I've written some books about it's it's a little counterintuitive that if you really want portfolio growth, the place to find it is not necessarily in revenue growth. It's in slower growing businesses that can pull other levers and cause their earnings and cash flow to grow very rapidly, and buy back stock, which causes the share price to grow very rapidly. So that's sort of the way that I approach the problem. And then the interest rates, just the only impact of the interest rates is whether that will then make my portfolio take off, or whether it'll be this part of the cycle where it's been a little bit more expensive. The recent, the 2020 drawdown, and that sort of seems to have signaled a return, I think, over the last sort of 6 to 12 months to a more traditional value strategies do seem to be working a little bit better in this market. And you can look at, ARK perhaps as a representative of, that's Cathy Wood's ARKK, as a representative of the flashier techie stocks, has struggled since February and is down pretty materially since February. Whereas, Berkshire Hathaway perhaps as a representative of as a collection of value stocks has done much better over the last 6 to 12 months. Interest rates and inflation going up will tend to benefit value stocks. So I'm probably a little bit biased that I'm always looking for that in the market, even though I do think that that's sort of manifesting now. I do think you can see that in the market. But I'm just sort of one person. What do you think? Do you see inflation? Is it understated?
Well, it depends on which number we are looking at. But I think you're right. It's probably higher than those 5.4 that came out last month. And is it
a high print?
It is. Is it 1-to-1 with the money supply, and with a lot of people, especially in the Bitcoin space, they're talking about you're chasing the same goods and you're pulling that lever. And I don't know if that's necessarily the case. I can easily see why you would make that argument, because it does sound intuitive. I think it's also important to understand that it's at interest rate 0, and so you have to pull all the levers, and so it's a derivative of that number. So there's a lot of money effect put out into the system whenever you lower the interest rate, which might just look different from an M2 perspective compared to all the quantitative easing that you're now seeing. And so you see these crazy numbers, and you're talking about, that should mean XYZ for the asset prices. So I don't necessarily see that as the case, but I do want to say that inflation has had an impact on how I invest. I don't know if it's just a natural progression of getting more experience with investing. But I would say that probably in 2017, 18, I sort of started to think differently about holding my cash position. Before then, I've learned from Warren Buffett, just like I guess most people listen to this podcast, and him and especially John Munger, they talked about having cash lying around and always be ready to pull the trigger on something that's really cheap. And I did that. I did that for many years, and of course lost something in opportunity cost. I also hit a few home runs, so it wasn't all bad. But whenever the market just rallied and you're 30% in cash or whatnot, everything else equal, that's just not beneficial for you. And so whenever I saw that inflation, it was probably around this 17, 18, and like you, whenever you're saying, M2, that's probably overstatement, and CPI is probably understatement. I would agree with that. You could also say it's a pretty wide range if you're saying between I don't know, 5 and 15 or whatever the current number is. But I quickly came up with the conclusion that even if it was 5% or something like that, which it wasn't at the time, but even if it was 5%, that's a huge opportunity cost that I had to beat. And it just made sense for me always to be invested in quote unquote something. Obviously, I wanted to be something that was cheap, something that was a good investment, all that stuff. But it always made sense for me not to have cash around. One of the things that you told me, Toby, really stick with me, because at the time I remember we talked about Warren Buffett, you and I, and how we talked about being 70% in one stock, what's wrong about that? You know, if you have a high conviction, you know, put 70% into something that's a really good business and that's cheap and you'll make a lot of money. And you said we always have to think about, is this statement true? And you said for Warren Buffett, yeah, perhaps it is true. It's true for me, Toby. It's not. And I might paraphrase, so please tell me if I'm like putting
No,
words
that's
in your
right.
mouth. So, and you know, I thought a lot about that, and I was like, yeah, Buffett is right and Toby is right, and I don't in any way think that I'm as good as an investor as you, and I'm sure they're not as good an investor as Buffett. So I was like, yeah, I probably should be 70% in anything, which it wasn't at the time, but it really made me think and become really humble about not understanding macro to the extent that I wanted to, and I would also say not understanding micro to putting something like 70% into one pick. And at that time, as with I guess many other investors, I had some hits, I had some misses, and it was just one of those where I pivoted to this. I always wanted to, like, I don't want to build positions more than 10%, but also let it run if you know if I'm right on that pick. And so it also made me realize, now that I'm putting myself where I would lose some of the potential upside in not putting more than 10% into one pick, assuming that it was the right one. Well, I would also lose some of that just from not being Warren Buffett a great investor, because that opportunity cost for me is much more expensive, not because I can't make Warren Buffett returns, but because I can't pick the same stocks. And so I was like, okay, let's say worst case 5%. Okay, you lose 5% with, when you know 30% of your portfolio, 1.5% you're losing every single year if you average. And who am I to tell that I'm average? You know, I've had good years, and I think, well, if Warren Buffett is ever looking for, you know, I think most of us probably thought about that at some of our picks, and then at other times we were like, oh my god, I'm just not worth myself. Like, it's embarrassment to other people if they ask me to like invest their money, right? So it's I think we covered too much of a ground with that long ramble there, Toby. But I guess that's sort of like how I'm looking at inflation, and sort of like why I'm now thinking about opportunity cost in I'm missing out on some of the best gains, but not being as aggressive as it used to be. But I also feel that it's been quite profitable by always being invested. And of course, you can argue, well, you know, the last 4 years won't be like the next 4 years, but just from doing that, you know, that's 1.5%. Assuming that's, you know, you have 5% inflation, and the market has a lot more than that. So let me throw it over to you again.
Yeah, that does make sense to me, in the sense that yeah, so you've got this 1.05% of your portfolio, of whatever cash you're holding, as being, the purchasing power of that is going down year on year. The only thing that I'd say is that it's been a very long time since we've had a genuine bear market, and the market is expensive at the moment. So it's possible that it's ahistorically high. Really, the only times that it's been higher than this is the .com boom, right at the bubble right at the very top last few months. We're at 39, I think, on a Schiller PE. Last time I looked, it's been as high as 44 at the very peak in 2000. And then the market didn't do anything for a very long period of time. So I don't know if you can look at the last short period of time as being representative of what is going to happen in the future, just in the sense that, but having said that, I've done lots of testing about what strategies tend to work, and it carrying cash just does tend to reduce your returns, just to the extent that, you know, the lower your exposure to the market, whatever return you're going to get a lower return than that over time. And you're assuming that you can deploy it all when the market goes down. You have, you know, it's scary when the market goes down like that you'll have the presence of mind and the fortitude to get fully invested. I just know myself that I don't have that. And so I have a different approach to money management, to holding money, waiting for those sort of times. I run a short book as well as a long book, and I carry some cash. And just by virtue of the fact that one side of the book is working and one side of the book isn't, I'm always rebalancing towards the thing that's not working. So I'm putting more money to work, either long or short, as the market's moving around. And that's how I sort of get around it. But I have some sympathy for that view that it really is an opportunity cost holding cash, particularly when the rates are so low. Where previously in 2000 rates were at 6%. If you didn't want to participate in the market at a 44 times Shiller K, which the inverse of that is about 2%. You don't want to get a 2% yield. You can go and get 6% in the 10-year, and that's something that tends to rally if there's a crash. So you were paid to wait, and you had this tail risk protection holding that. Now that's a different story. You got 1.3%, which is below the rate of inflation. So you're compelled to be exposed to equities in that market. That's the explicit policy of the Fed, is to induce risk taking by investors, which is why we have a stock market where it's at, and we have interest rates where they are. And so you can't get enough return from the safe stuff, and you're forced into the market. And so that creates, I think, this sort of crazy behavior in the market where we've got these tokens and the NFTs and those sort of things. I don't know that the use case for those has been fully proven out. There may be one eventually. I just, at this, as where it stands now, I don't want to go and put my money into those things when I can find a company that produces goods and makes a profit and generates free cash flow and pays that out to shareholders. That just seems to me like an easier way of doing it.
Yeah. I can't remember that that we more or less ever had, and we probably talked like 20 times here on the show or something like that. We always talk about the market being expensive,
and it's been expensive since 1996.
Right. So yeah, it's unbelievable. And I think it was Benjamin Graham who said something like, "Yeah, I had a good track record, but I only had 4 decades or something. I should have a much longer track record to prove." I can't remember. It was something like that. Perhaps it was 5. But you're like, okay, right. I shouldn't be looking at the past 4 years or 2 decades or whatnot. It's unbelievable how long it's been expensive. And so one of the things I've been puzzled about is I've looked at different value ETFs, and very often most of them are US based only, and some of them are international, and then in that case it's typically only international. I think our friend Wes Gray have one for instance. But why is it that if you have a value ETF that you don't have a global value ETF? Why is that not more common? Because you would think you can find more value if you have a bigger universe.
It would include the US and international. Is that what you mean, rather than just yeah. I think probably that's driven by just the investment choices of, investors want a US investors want a US focused ETF, and there are lots of US investors around, so you can make a business with a US focused investment, with a US focused ETF. And then if you already have US exposure, when you go to set up your next ETF or your next fund, you don't want to double up on the US exposure, so you get international exposure to complete your own exposure. But I agree with you, it's an imperfect way of doing it, because globally the US has lots of really good consumer discretionary companies that just don't really exist anywhere else in the world. So a global portfolio will be reasonably heavily weighted towards US companies anyway. And so an international portfolio just gives other countries a better showing in the portfolio. You get more exposure to, if you just exclude like the 45% of the market, which is what the US S&P 500 represents, I think, or the US market is like 45% of the market. If you exclude that, you're just going to get a better concentration of international. But I agree, and this is why I'm pretty eager to talk about your pick, because when I look, so Buffett gave this great, at the last meeting, he put up these 2 slides, and he said in 1989, I think it was, this is what the 20 biggest companies in the world look like. I think it was something like that. And it was there were a lot of Japanese companies in there. There were a lot of US companies in there, and there wasn't much of anybody else. And then he replicated that slide as at 2021, and it was dominated by US companies. So it was maybe one Japanese company in there, and there were a handful of Chinese companies in there. And I think if you wind that forward 30 years, probably what that will look like is it'll be dominated by Chinese companies. There'll be quite a few American companies in there, and there probably won't be much of anything else. And so I think if you're an investor thinking about the next 3 decades, say, you probably should be looking at China. And there are some, when you do that, there are some phenomenal businesses in there. And this might be an unusually good time for it because the regulatory changes have resulted in all of those tech stocks getting absolutely smashed to smithereens. And so I know what your pick is. So
Right.
do you
Yes.
want to jump on that?
If you, it sounds like you want to roll there, Toby. I don't want to stop you. Yes, my pick is Alibaba, and I'm not necessarily saying it's your traditional value pick, and so perhaps it was a bit misplaced whenever I asked you about that in terms of ETF. I guess where some of my I don't know if you should call it frustrations, but at least like thoughts comes from is that just from being like a big universe like the US stocks, you can't obviously find value picks by, that's just how it is. But at the same time, if you look at our tool, TIP Finance, we have 23 developed markets in there. The US, the most expensive. And so you're fishing where the fish are not. It's a big pond though. Like the US is the biggest pond, but they're not a good, water to fish ratio. I don't know if this is correct English.
That's fine. That makes sense. You're quoting a Charlie Munger. You're quoting Charlie Munger there, and he's I know he's got a position in Alibaba too. So that's why. I mean, I've looked at quite a few of these stocks now. I think Alibaba's interesting. Tencent's interesting. JD.com. There's a whole lot of really interesting Chinese stocks in there.
That's all specifically why I wanted to talk about Alibaba, because it was one of the stocks that I found particularly interesting, and I think I understand better than a lot of the other Chinese picks. And that was actually to tie it into back what we talked about before, and having that in the ETF. And I'm not trying to say run out and start an international ETF after this. It's just one of those I'm like, I just see a lot of value there, but it's hard to get to, right? Just never mind that I live in Europe and it has to be specifically certified here in Europe, so it's even harder here. But like even in the States,
that's the ETF, yeah,
right. The Chinese/Indian value ETF for all of us who can see the value there, but can't access them and don't feel too comfortable about going into this, huge but to us weird-looking Chinese or Indian company, right? And so. Anyways, I wanted to talk about Alibaba today. I actually already pitched that back in Q1 2019. And at the time, Alibaba was trading around 170, I want to say. And it's almost back to that today, actually. I was, and these are one of the few lucky breaks I have here in my life. I sold it earlier this year. And it was.
Did you sell it pre-Munger going into it?
Yes.
Or post-Munger going into it? Before
pre-Munger,
right?
Yes. And so it doesn't make me feel good whenever I sell something that Munger buys. But except in this very specific case where it seemed to be fantastic. So I decided to liquidate my entire position and it was sort of like a few reasons. One of them was my wife and I were moving, and we bought a new place, so I needed to have some funds. And the other one was that I wanted to just liquidate the entire portfolio because at the time I felt like Berkshire was probably undervalued by 30 or 40%, and so it was just one of those where I'm like, yeah, Alibaba trading at 250, 300, whatnot. It just seemed. It actually didn't seem overvalued to me. But it just seemed like, yeah, it might be fairly valued. Definitely didn't feel like it was like undervalued at that point. So knowing that we have to, release funds, tax stuff, Berkshire being just slightly more attractive, I just liquidated it. And Again, talk about more luck than skill, because not only has Berkshire gone up, that's actually not what I've been most excited about, but Alibaba just blew up. And it wasn't because Xi Jinping called me and said, I'm going to crack down on Chinese tech. It wasn't anything like that, but it has just plummeted, right? I think it's like, what, 175 or something right now. The market just opened.
Did you sell it because it was expensive? What was the reason for selling it? You just thought it had gone too far?
No, at the time it just seemed to me it was fairly valued. And then, going back, I needed to sell some stocks for the down payment for a new condo. So that was, I mean, I could easily see myself hold on, like, if we moved next year instead. It wasn't like any kind of
it wasn't necessarily specific. It was the most or the closest to fair value in your portfolio. So you wanted to ship the thing that was closest to fair value.
Yeah, looking across my portfolio, it seemed in that range, which was fairly valued. I guess I could probably still have come up with a thesis why it was still, call it 20% overvalued, but it's all relative. It was the same thing for Bank of America that I sold for $42 or whatever it was. It was just one of those, and I had some other stocks where it just seemed like the least bad idea, because I generally don't like to sell stocks if I can avoid it. Okay, so since then, the Chinese government has just been hitting big tech hard. Educational companies, they decreed that they can't be profitable. So you can imagine what that had done to the share prices of those. And then you had investors like Charlie Munger, who bought in Q1 already. I think Mohnish Pabrai did at the same time. Mohnish Pabrai added here in Q2. Guy Spier built a new position, and they probably bought in the 210, 230, perhaps a bit higher, especially for Munger, it came in a little earlier. So they bought in that range. So the stock trading at call 175. I'm not saying that you just go out and buy it, but it definitely makes you wonder if there's a value there. And so I did take a very small position. I think it's one of the things I always like to put up as a disclaimer. I was thinking actually at the time it was like lower than 200, and I was like, yeah, why don't I just buy a few shares? So I have this thing where I buy very little stock in a company. It's less than 1%, just because I don't know if it's just me getting lazy or what's happening, but I have a hard time sitting through earnings calls and reading 10Qs and 10Ks if I don't have a little skin in the game, even if it's very, very little. It's just like a mental thing. I absorb things differently. And so I decided to do that. I kind of felt like at 200 or 198, which was I bought a very small, less than 1% position. It couldn't go entirely wrong. Well, so far I've been wrong, but it's like catching a falling knife, right?
But it makes sense to buy a little bit, and then because it's optically cheap, and you've got lots of good signals. Charlie Munger owns it, Li Lu owns it. There are a few other investors in there too who you didn't mention, who I know who are very well respected, who picked up some. So yeah, it makes perfect sense to It makes more sense to buy a little position than it does to go and buy your whole position before you've done your research. So that's appropriate, right? Buy a little position because those are good signals. It's cheap. Charlie Munger's bought it, so on. Now you go and do the real work to determine whether you're going to ramp it up to a full position or not.
Yeah, and also I kept up with the different earnings report since I built a position. But as soon as I sold out on it, yes, I noticed like what the ticker is saying, but I'm not really drilling into the stock so that was sort of like why I did that. So let's revisit Alibaba here in Q3 2021. Massive company, right? 1.18 billion active customers. Just think about that. If we break that down into 4 different business units, 87% of revenue comes from core commerce. So that's primarily the Chinese e-commerce through Taobao. You can think of Alibaba, if you're not comfortable with, or if you're not if you don't know too much about the company, perhaps if it's one of the first time you're hearing about this, just think about it as the Amazon of China with a lot of localized tweaks. It's different. But you can buy everything just like you can on Amazon. 8% of revenue comes from Alibaba Cloud. This is the segment you better watch out for. We've seen just last quarter, year over year for the June quarter, 29% growth. And this was actually quite disappointing growth because they lost ByteDance, the owner of TikTok. So if you adjust for that, we're much more than 29%. So if you actually looked at it and took that out, and you look at it year over year, we're close to 50%. So it's now a $10 billion business unit with a lot of growth ahead. If you look at the global market share for the Alibaba Cloud, it has around 6%, and as that makes it the fourth largest market share in cloud computing. So it's trailing Amazon, Microsoft, and Google. However, I would also argue that for the time being, Alibaba is not really competing in the West for cloud computing, just like you would say Google is not competing too much in China. I would rather say that you divide up between East and the West, and you might even just say China. Alibaba by far is the most dominant player, and they have 3 times the market share as Tencent Cloud. So if you look into some of the stats, Asian providers prefer, or Asian companies prefer Asian providers. I would imagine it's the same here in the West. We had to decide on just internally in company on a cloud service. We looked at, I want to say 4 or 5, all of them were American. It wasn't even like it was conscious thing. It's just one of those things like, where do you want to store data? I don't want to store it in China. And I don't think we even made that analysis. I think it's something that's subconscious. And I would argue that you would see a very, very high growth in Asia, specifically China, probably more than in the West, where Alibaba would just have that first mover advantage and the ecosystem around it. You can say to some extent the same for Tencent. The cloud business, as much as it's 8% of the revenue, it doesn't make a lot of profit. It just turned a profit though, but it's not the most profitable unit. It's all about growth right now. Then you have 3 to 4% of the revenue. That's the digital platform, entertainment and video. So the crown jewel here is Youku. You can think of it as a hybrid between YouTube and Netflix. They have more than 500 million users, which makes it the 3rd largest in China. It doesn't make it the biggest. Both Baidu and Tencent actually have bigger providers. And then you have Alibaba Pictures and other entertainment. They also have gaming. They have a few different things in this unit. It's not profitable. It's growing a decent clip, around 12% a year right now, but like we do see some growth on that. And then they have less than 1% is something called Innovations Initiative and Others. And the best way to think about this is similarly to other bets for Google. So you can think of as Alibaba has like a small army of companies that are not generating any revenue or very, very low revenue. They have a big risk of failing, but you have a lot of potential upside in that too. And when they become profitable, it will be broken out, just like Waymo was one broken out, YouTube was one broken out in Google's statements. The way that Alibaba operates is that they generally take large or controlling stakes in acquisitions, and they do not consider themselves an investment company. So this is different than Tencent. That they have a very mindset of investing in a bunch of different businesses, and then they're an investor. They made a significant investment in Pinduoduo, Tencent here I'm talking about, and they let them use their ecosystem. It's a way of growing too, but they're investors. Yes, they are on the board, but they're not operating the company. Alibaba has a different mindset. So if you look at the valuation, and then we can perhaps afterward go back and have a conversation about everything that's going on with the regulation, which is just a big mess right now. If you look at the valuation, what is Alibaba worth? And it's a tough question. I can come up with a range between $250 and $350 perhaps. And this is for a stock that's trading at called $175, but it's hard, and you can argue for an even wider range. It's trading at 20 times free cash flow. Is that cheap for a company that's been growing earnings per share on average for the past 3 years of 30%? Yeah, it's pretty cheap, right? It's not 30% in total, it's 30% annually. You have a company here with revenue over the trailing 12 months that is 40%, and over the past 5 years it's averaging 47%. Like 47%. So you can argue that in a world where the interest rate is zero, this is and it's a company. We go back to the discussion about inflation. By nature, it has a inflation protection. Like that's in the nature of the business. And so meaning you don't have all those capital expenditures, you don't have to lay the tracks for your railroad or whatnot. But let's flip it. Let's say you have a company that's trading at 20 times free cash flow. You have an unpredictable and totalitarian government. Is that cheap? No, it's actually quite expensive whenever you have like a big unknown like the Chinese government. And it's hard. So what I would suggest that people do is, I guess as with all stocks, come up with different scenarios, assign percentages to that, and then discount those cash flows back. So that was my pick, Toby. I want to throw it over to you for any questions, thoughts on this pick.
I really like it. But I've got some real questions. The questions are: what is the impact of these regulatory changes on Baba? That's the first question.
So it's not pretty. If you might remember, Ant Financial was really something everyone talked about in the financial world, which was not fully owned by Alibaba, but Jack Ma was a controlling shareholder, and Alibaba had made a major investment. At the time, I think it was valued of more than $100 billion. And they had an IPO where I think the goal was to raise 37 billion, stuff like that. So this was a massive company. And all of a sudden, it just stopped. Like the regulators just said, nope, you can't do that. And since then, they've started to force Ant Financial to open up to some of that data. So all of that hasn't been played out, but the government want access to that data, and they also want rivals to be able to purchase that data in a marketplace. And it hasn't really been figured out, and then what's the price, and is it all data, is it some data, but it's not pretty. And so this is my long-winded way of saying I don't really know what the entire impact is, and it seems like the market doesn't really know either. But they don't like it. I don't think that you won't see like they did with the educational sector, where they just said, no, you can't really make a profit anymore. I don't see that happening. Again, I would never have thought they would come out and say, no, these business can't make a profit anymore. So it is definitely a major risk.
Do you know what drove the changes? What was the rationale? What was what reason did the government give for the changes?
So they said that the party line was something like, we want more social equality, which is a bit ironic when if you really think about it. And they wanted not just social equality, but they also want a better competition. They wanted to curb the market powers. And so this is something generally that people, and whenever I say people, the population likes to hear. Like, just like here in the West, in China, they're also afraid of, companies collecting their data and what they would do about it. But I think it also served a different purpose. If you look at just the country is just so different, right? You have Xi Jinping, the president, who have sort of he changed the legislation in terms of how China is now ruled, and it seems like he's more or less giving himself infinite runway to steer the country in whatever direction he wants to do. And I think one of the issues was that he saw potential rivals, and he saw potential rivals that didn't necessarily like the Chinese regime. Jack Ma would be the poster boy for that. He sort of disappeared from the public eye for 4-6 months or so, and he came back a lot more humble. Like, he was quite an open critic, especially for a Chinese prominent person, and he came back speaking very differently about the Chinese government. Not long after that, I think it was only like within 3 or 4 months after that, you have two very prominent people in China that removed themselves from the public. One of them was the founder of Pinduoduo, Con Huang, but also the founder of ByteDance, who owns TikTok. And so I think it was also a signal that he's in control. I think it's a power play. If you look at the legislative body, like, you have so many wealthy people. I saw this. I just put this up here. I don't know all the numbers by heart, unfortunately. But if you look at the 83 wealthiest NPC from NPC and CPPCC, so you can basically look at this as legislative body. They're basically delegates. They have an average wealth of $3.35 billion.
Good for them.
That's a lot. And this is like, I wouldn't call them admin workers, because that would probably be like the wrong thing to say. But like, these are the people like on Xi Jinping's side who are running this country. They are determining the laws, the outlook for the company. In comparison, if you look at the US Congress, and don't feel sorry for the people in the US Congress, if you look at the 83 richest members, they have an average wealth of $56.4 million. That's still a lot of money. But whenever you compare it to, what is that, 60 times what they would have in China. And so it's just, I think it was one of those power plays more than, I wouldn't say more than anything else, but I definitely thought that played in.
Yeah, so that's sort of the next question was, what does that mean for the regulatory landscape more generally? So it just means that probably it's a little bit more unpredictable. Is that fair, or that there's potential for more of this? How does it differ from what you see in the States? Like, what the States, if a company gets too big in the States, so Microsoft had antitrust legislation against it in the early 2000s, or antitrust action against it rather, and there's sort of rumblings now in the States, and there has been for about 5 years, about the bigger tech companies here, that they may have too much market power, or they may be collecting too much data, or they're exercising some censorship. How is it different from, nothing's happened in the States, so it's purely theoretical, but what's the difference between the two?
Speed and magnitude, I would say. Let's take Google, for instance. Sued last October 2020 by the DOJ and 11 states for monopolistic abuse. That has, and it's only been for the search business, not for anything else. That will come before 2023.
I see. Yeah.
In comparison, if you look at what happened with Alibaba, and not just like stopping Ant Financials like from one day to the next, like their IPO, it took less than 4 months to slap a $2.8 billion fine on the company and open them up to sharing data. And so, I guess I see this differently than whenever I read through all my notes here from 2019. I typically, for these mastermind meetings, I typically prepare between like 8 and 12 pages, something like that. Luckily, I don't go through all of them because I think people would be bored if they. But like, I'm just like, at the time, just like writing, this is what I'm thinking, this is the outlook. And I remember one of the things I wrote was, China has, and thereby Alibaba has, a significant advantage to the US because they are allowed to collect data, and they can collect more of them, and they will cooperate with the Chinese government, so they would have a leg up because because it's a global power play to be the front runner in AI, for instance. And now, I guess I think differently about it. I still think that, obviously China, the Chinese government will still like collect that data and figure out what to do about it. But I'm not sure that big tech in China have the same advantage as I used to think. I think they have the advantage in the sense that they are allowed to collect more data than in the West. The individual company probably wouldn't have the same moat as I thought they would. Chinese companies in aggregate would probably still have a moat compared to what's happening in the US. Simply to operate on the Chinese market, you need to give green light to different type of data collection and to different type of IP, which you don't have to do in the States, for instance, if you come as a Chinese company, at least not yet. And so the Chinese government just have, and especially if they are forced companies to share them, like they will merge one or two or how many winners who would then figure out what to do with that data. And so collectively, it might be an advantage for the individual company, in this case, Alibaba. I don't necessarily think that the advantage is as big as I used to think. And so whenever we look at this as investors and we're like, yeah, we might not care about politics or whatnot, but we're going to where the value is. It's I sort of like see it as the opposite of other bets. You have this other bets, which for Alibaba would be something like Ding Ding, for instance, which is like a workspace corporation tool. But like you can think of this as what Google have with other bets, with all these DeepMind, all that cool stuff, where you would say it's really difficult to value what all that is worth. They're not generating too much revenue. How profitable will be? They're actually just burning cash, but it probably has some value. It would be weird if it didn't have any value. So you might be willing to pay a bit more for the rest of the company. You would probably need to understand, in Google's case, you would need to understand like the advertising space pretty well, because that's how they make money in terms of search. And I would say, to go back to Alibaba, just like I would pay more for the e-commerce and cloud business, because that's clearly going to be profitable, and it's easy, especially for the e-commerce business, to figure out what that's worth. I'd probably pay a bit more from that because of other bets. But then I would also say I would pay a little less for the company because of these regulatory pressures. And so it's a bit more art than science. I think that's what the late Runsworth would call an known unknown. We know it. We definitely know it's an issue with tech, and the installation you're seeing right now that's being taped around it. It's just too hard to tell how bad it would be. So it's not a 70% bad, in case you're wondering, Toby. It's not a 70% bad.
When I look back over where it has traded over the last 5 years, this is about as cheap as it has traded over that period of time. I don't think the question is so much. I mean, it's optically cheap, and you're probably getting the right odds for a bet on it just continuing to do roughly what it has done, or maybe just a little bit worse than that. If it does that, you're going to make out really well in this position. If there are material changes to it, then all bets are off, and who knows. But I think it's a good opportunity, potentially, to grab something that is spectacular, because the upside is huge. If it does go back to doing what it had been doing, and you get some of those other bets paying off, the risk reward is good. The risk, if anything, has sort of been priced into it here. And so I think that I like the position. I like a few of these sort of opportunities, just for that reason, that where previously they had there was a lot of, you had to be right on what the underlying business did, because you were paying up for it. Now the valuation is to the other side. You've got this opportunity. nobody really knows what's going to happen, but at least you sort of you're getting the right odds to take the bet.
Yeah, that's sort of like how I'm looking at it. Yet, and I try not to be anchored with the tiny few shares that I bought here at 198 because I do think it looks cheap. And I came up with this. What is it worth? And I said between 250 and 350, and you can really make an argument that that range is just not wide enough. But do you dare putting some numbers on how you look at the intrinsic value for Baba?
Yeah, it's. I mean, I wouldn't. It's too hard. I do think that you can look at it on a ratio basis. It's as cheap as it's been in the last 5 years. It's clearly the underlying business is spectacular because it's got massive returns on equity. It's growing incredibly quickly. They've got lots of other little businesses that aren't even included in that are still burning cash that might be opportunities down the road. All of those things, like the cloud, is very early days still, and that's been a monster business in the States for Google and AWS and for Microsoft as well. So I like the opportunity. The risk, the thing that you got to get comfortable with is the regulatory regime. That's true everywhere in the world. This one might be a little bit more arbitrary and a little bit more aggressive, but then, I think regulatory regimes global are pretty arbitrary and pretty aggressive too.
Oh boy, yeah, I definitely agree with that. And one of the things that, and again, I'm trying to be my own devil's advocate. So not only with my good friend Toby, I actually try to take myself down if I can. And I guess one of the things where I look differently today here in Q3 2021 than I did in Q1 2019, whenever I built the initial position, which was at the time it was I think it was in like 7% or something like that. So it was a quite significant bet for my portfolio. I think where I looked at this differently was that I really looked at them having this massive moat in e-commerce. They have their own ecosystem. Like you have to go to, and it might sound odd that it can be a moat that you have to go to the website and you can't find it anywhere else. So let me just tell you a bit more what I mean by that, because for instance, like Baidu, like called the Google of China, right? So what Alibaba is doing is it actually blocks Baidu's spiders from indexing of both Taobao and Tmall, which is the two primary sites. And so you actually have to go directly into Alibaba to buy. And they have the whole ecosystem around it where you need to enter the ecosystem. And then it's very easy to buy and it's very convenient for you to make any purchase. And that also makes search a lot more valuable. That makes the advertising dollars go up really quickly because it's very efficient for Alibaba. And I saw what Tencent were doing with their ecosystem, and it seemed to me that it made sense there would be like this duopoly and would be really, really hard to get into that market. And then Pinduoduo comes in. Like, in this year, they're probably going to sell more than JD.com. Not more than Alibaba, which is still a significant first. But like, I was surprised how fast that happened. And so I guess one of the concerns I have with this pick, still, I see great value. But one of the concerns I have is just the disruption that I see in Chinese habits and how I've never seen that coming with Pinduoduo. So just one more thing to be cautious about and look out for if you want to invest in this. If I can ask you one question, Toby, about this, because this has been like it looks like a falling knife. It looks ugly whenever you look at the how the price has moved here this year. I read this book by Steven Schwartzman. I think the book was called Whatever It Takes, What It Takes. And he talked about building Blackstone and talked about how he made money in Blackstone, and he talked about how he would never catch a falling knife. He would always look for the bottom and then want to see at least a 10 to 15 increase from any button before he would make a position, because otherwise it could get really, really ugly. And you would pay a high opportunity cost from having to wait, even if you think the intrinsic value is on your side. Do you think there's anything to that? Is that something you looked into at all? I'm just curious to hear your thoughts on that.
Well, the way that you can deal with it is by you combine some sort of momentum measure. I don't know that it necessarily changes the so you look at, when I say momentum, you just, like you say, it's bounced up from some point. It's not still falling. I think that it doesn't statistically across a number of positions, it doesn't really improve your chances, or it doesn't really improve your returns on a basket of positions. I'm sort of valuation only. I don't really care so much what the stock price is doing, because these things bounce too. They can bounce really hard and really high, and then you miss your opportunity. I think you look at a stock price chart and it's joined together in time, and it looks like it's got this sort of momentum and movement to it. But really what it is just people transacting at different prices. And so you get the opportunity that you have based on the market price where it is and what your assessment of the value is. And then if your timeline is long enough, like if you're thinking in a 3 to 5 year, 10-year timeline, does it really matter whether you get it here or up 30% or down 30%? Probably not. So I think you take your opportunities where you find them. So you don't worry so much about where you think it's going to be in the future. In the short term, you just buy it here, and then buy if you're worried about it continuing to fall. Don't buy as much as you want. Buy half a position or a third of a position, and then if it bounces 10 or 15%, that's your signal to buy the whole position. And if it falls another 30%, then you can buy a little bit more, and maybe you go to a half position at that point. I think it's kind of impossible to know. You just got to look at the odds that are offered at each stage and make your decision based on that, rather than where you think the stock price is going to go.
That makes sense. And what does he know, Steven Schwartzman? Just because he built Blackstone.
He's a private equity guy too. I mean, he
right.
probably knows quite a lot, but he's primarily a private equity guy. I don't think that he's doing that when they're buying things privately. They don't go in and say, what price are you going to offer? And they say, well, it's
right.
It's $1 billion. And then they go back next time and he says, what price are you going to offer? They say 500 million. He says, oh my God, it's a falling knife. Yeah. I can't buy it here. I'm going to come back, and when it's at 600 million or when it's at 575 million, then I'm going to buy.
Right.
Because that's a 15% bounce.
Exactly. No. Cool. Yeah. Anything else you wanted to talk about here today, Toby?
No, I think that's me covered pretty well.
I'll let you go here, Toby. But before I do, I would like to give you an opportunity to tell a bit more about where people can find you, and what else you have, what else you're doing other than being on this podcast.
Yeah, I run 2 ETFs. The first one is called the Acquirers Fund. The ticker is ZIG. It's long and short, US domestic companies, deep value. And I run a small and micro version of it that's just long only and a little bit more diversified, called Deep, DEEP. I also have a podcast called the Acquirers Podcast and a website called acquirersmultiple.com. And I'm on Twitter at Greenbacked. It's a funny spelling, GREENBACKD. And I've written some books. The most recent one is The Acquirers Multiple, which came out in 2017. It's available in all good bookshops, including Amazon.
That's amazing. And so for the rest of you out there listening to this, or perhaps you're looking at this on YouTube, make sure to subscribe, or follow us on Spotify, Apple Podcasts, whatever you're listening to this. All right, guys, that was all that we had for you for this week of the Masters Podcast. We will be back next week. Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.